Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some more of the Ask James questions of the day. First question is from Craig. He says, so why is President Trump doing this anyway with the tariffs? Yeah, Craig, well, to some degree, you're asking me to be a bit of a mind reader, and that's never an easy thing. All right. The rationale from the Trump administration is correct in that, we've had an unfair balance. We've had unfair trade balance, which means we've been importing more goods and services than exporting, which is never good because we want to export more so that our American companies make money and our American, workers make money and so on. And part of that is due to the fact that other countries had more tariffs against us, generally speaking, than we've had against them. And administrations in the past have just kind of let it happen because we're the Americans and we're supposed to be, all benevolent, right? However, the Trump administration has really blown that out of proportion. What they're saying are the tariff imbalances are, to a much greater degree than they really are. So yes, they're imbalances, but not as great as the Trump administration would lead you to believe. Moreover, Craig, the Trump administration is, I think, intentionally conflating a couple of things. They're conflating what's called a value-added tax. Now, most countries have a value-added tax, which essentially is a sales tax for a national sales tax. Now, we don't have that. Now we have sales tax, like state sales tax. Most states have sales tax. In my home state of Delaware, no sales tax, but most states have a sales tax, not a national tax, right? So what they're doing is they're adding that on and saying, well, that's increasing the price. So they're kind of calling that a tariff. And it's really not, it's just a national sales tax. So initially, the plan, may not have been too bad if they just raised the tariffs to some degree as a negotiating tool, because in Trump's first administration, Craig, he did come back and say, hey, why don't we go to all zero tariffs? We'll remove ours as you remove yours. That would be an ideal scenario. If they raise them to a certain degree as a negotiating tactic to go to zero tariffs across the board, that would be okay. But when the tariffs got announced, it came out at a much greater level than anybody expected. And now it seems like, every night there's a tweet coming out that shows you another increase in tariffs. So it's gotten so far out of hand that, I don't know what the end game is here. But, there can be some serious consequences to all of this. Inflationary, really. Now, this is particularly important for those investing for retirement income. These tariffs can create market volatility that directly impacts dividend-paying stocks and bond yields, the very investments many of you rely on for consistent income streams. Now, some sectors may benefit from, protectionist policies in the short term, but the broader economic uncertainty could pressure the stable income-generating investments that really form the backbone of many retirement portfolios. As income-focused investors, we need to watch how these trade tensions might affect traditionally defensive sectors like utilities and consumer staples that many retirees depend on. Craig, thanks for a fantastic question. Relevant today. As always, if you would like to send in your question, you can do so. You can email it to poollocke@poollocke.com. Moving on to our second question is from Cheryl. She says, I am just about to retire, but I'm worried if these tariffs are going to cause a recession. So what can I do? Well, Cheryl, hopefully you've already made the transition to an income first, growth second mindset, which we always think about, we talk about it in our younger years, right? You're total return focused, right? You don't care whether it comes from income, capital appreciation, growth, right? It doesn't matter. But as you get closer to retirement, it's first about the income, right? Interest and dividends that your investments pay out to you, and then growth or capital appreciation. That's really secondary. If you've made that transition, then you shouldn't worry right now because, yes, the value of your portfolio may drop. Yes, there might be some companies on, common stocks that cut dividends, but, certain preferreds, they don't cut dividends, right? Bonds don't cut interest rates unless there are bankruptcies and defaults, right? So if you've done that, you've already positioned yourself, right? If that's the case, for a good retirement. And if you've kind of locked in the retirement income, then you should be okay. Now, what if you haven't done that? Well, if you haven't, you have to look at the market right now and say, can I afford it? Can I afford to retire at today's values in my portfolio to make that transition? If I kind of snap my fingers and make it, let's just say in a matter of days or weeks, right? And normally we like to, make it gradually, that transition. But if you haven't made it, then what, right? So if you put it in perspective, the S&P 500 right now is a 20% drop that we have, really just puts us where we were a year ago, right? Because this whole tech bubble, all the, NVIDIA and all the AI stocks, everything else that heavily weights the S&P index, right? Those magnificent 7 stocks, they drove the market up. So again, it shouldn't be that big of a deal if you look at where your portfolio is now and say, yes, I can transition to that kind of income first, growth second mindset, and 4% of your income generated on today's value of my accounts would be enough, then I encourage you to, accelerate that transition. Do it now. Why is that? Because, well, if we do go into a recession, the market may drop another 20%. If we don't go into a recession, we might recover, maybe, right? Maybe you can get back some of those kind of losses, but do you really want to gamble if you're on the brink of retirement? Let me add that during uncertain economic times like these, with tariff concerns, diversification in your income sources becomes even more crucial. Consider adding some defensive dividend aristocrat companies that have increased their dividends for 25 plus consecutive years, which tend to weather economic storms better. Also, don't overlook fixed income alternatives like preferred securities, municipal bonds, if you're in a higher tax bracket, or even, REITs, real estate investment trusts, in sectors less affected by economic downturns. Remember that market volatility from tariffs or recession fears can actually create buying opportunities for income investors. Those higher yields on quality investments might be exactly what your retirement income strategy needs. Don't forget about having a cash buffer. 1 to 2 years of expenses and cash equivalents can give you tremendous peace of mind and prevent you from selling investments at depressed prices during market downturns. Cheryl, I hope that helps. The key is to stay focused on that reliable income stream rather than daily market fluctuations. That's what will sustain you throughout retirement, regardless of what happens with these tariffs. Thanks for the awesome questions today. As always, if you'd like to send in your question, you can do so. You can email it to poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.